Hello friends, welcome back to JK Shah classes. CA Final Direct Tax and International Taxation, that is paper 4. In this we are going to revise today this chapter called Model Tax Convention, MTC. What is model? Model means draft, that is rough. And what is convention? Convention means agreement. Convention means agreement, and draft agreement is nothing but a rough agreement. So supposingly you after becoming chartered accountant, your client approaches you and says he wants to make a partnership deed. So what will you do? He supplies you with the details of name, addresses, PAN number of all the prospective partners. What would you do? You are not going to make a new partnership deed. You will copy paste it from somewhere. You will have some previous agreement of previous client. You will copy paste that in the Word file. You will make appropriate changes, incorporate the names of new partners, PAN number, address, and you will prepare a new partnership deed. Same thing at international level. If any country wants to enter into a DTAA, then should have some base available. So that base is provided by OECD, Organization for Economic Cooperation and Development, and the another institute is UN, that is United Nations. These two international bodies have prepared some draft agreements. These draft agreements were, or model tax conventions, were prepared long back, somewhere in 1940s, 1950s, 1960s, and over a period of time they kept on making amendments. The latest draft or latest model tax convention for both of them is available as of the year 2017, and we are going to study that. Now before we start with this chapter, there are certain terminologies which are used here which we need to understand. The very first terminology is state. State here would mean country. Country is called as state at international level. In our country, we have state would mean 28 states, Maharashtra, Gujarat, Punjab, etc. But here the state would mean a country. There are two types of states, and we know pretty well the taxability of any income depends upon the country in which or the state in which assessee is resident and the state in which income has accrued or arisen or received. This state we will call it as state of source, and this state is called as state of residence, abbreviated as SORSOS, state of residence, state of source. The country of which taxpayer is resident is called as state of residence. Country in which given income is accrued, arisen or received or deemed to have accrued, arisen is called as state of source. Then the agreement is between two states. So those two states will be called as contracting states or the contracting parties, also called as treaty partners. Alienate and alienator are the next two terminology. Alienate means transfer, generally capital asset. In India we use the word transfer, but here at international level they use the word alienating of the property, alienation, and the person who is a transferor is called as alienator. Then map, we had a reference of the term map in transfer pricing chapter also, if you recollect, while discussing advance pricing agreement, APA. MAP would mean, full form is Mutual Agreement Procedure. Whenever there is a dispute between two states, they would finalize the matter, they would decide upon the matter, or they would resolve the matter by sitting together on a table, and they will mutually agree upon some conclusion, and they will enter into some justification and some agreement for that. That is called, this entire procedure is called Mutual Agreement Procedure, MAP. And competent authority here would mean the tax representatives of two states or two countries, generally finance ministers of two countries and their team. Okay. Now in order to enable people or provide guidance to countries to enter into DTAA, OECD and United Nations, they have drafted two agreements. These are called model conventions or model tax convention. They are not binding on any country to follow because they are draft agreements. This is not a law, these are binding, these are rough agreements. Most countries have adopted these two either in entirety or by making minute changes. There were two model conventions. Which two popular model conventions are? One is OECD and the other one is UN. India generally follows UN model conventions, that you need to remember. Okay, now what is the difference? So OECD model convention is generally adopted when the agreement is between two developed countries. And when one developed country and one developing country, then ideally they will follow United Nations Model Tax Convention. Okay, one developed country and one developing country, and India generally follows UN model convention. That you need to remember. What is the difference? So fundamentally only one difference is that as per OECD model convention, the right of taxation, these model tax conventions or the DTAA, basically how they avoid double taxation, they assign the right of taxation to either of the countries, either of the states, that for this income SOR will charge tax, for this income SOS will charge tax, and for this income both the countries can charge tax. That kind of assigning of the right of taxation is done by DTAA. So according to OECD model convention, for most of the incomes, in fact for all the incomes, the right of taxation is assigned to SOR, state of residence. And as far as UN model is concerned, which India generally follows, here also right of taxation is given to SOR only, but in some cases SOS, state of source, can also charge tax, but SOS can charge tax at a concessional rate, not as per normal rate. Now these model tax conventions, MTCs, are divided into various chapters, and chapters are divided into paragraph. Chapters are divided into articles, articles are divided into paragraphs, and paragraphs are divided into sub-paragraphs, or they are also called as clause numbers, clauses. Chapters, articles, articles, after that paragraph, paragraph, thereafter clauses. Now in India we divide income into 5 categories, 5 heads of income: IFHP, salary, PGBP, capital gain, IFOS. But here incomes are divided into further more categories, ranging between article 6 till article 21. We have 16 types of different incomes. However, our institute has not covered each and everything. The title of this chapter is Overview of Model Tax Convention. So out of total 31 and 34 articles, in OECD Model Convention there are 31 articles, and UN Model Convention there are 34 articles. 3 articles are more. Out of them our institute has covered only 16. Whatever is covered, we will be 14 articles, not even 16. We will be discussing 14 articles. That's why the name of the chapter is Overview of Model Tax Convention. Now the very first article, where the content is common between both the model conventions, that's why I have merged them. This is the title as general scope, means persons covered. General scope as in on whom will it be applicable. So naturally it will be applicable not on each and every person in this world. Suppose there is agreement between India and UK, then on whom is it applicable? So answer, Indo-UK agreement will be applicable to those people only who are residents of either UK or India or both the states. Those who are residents of one or both the contracting states. However, how to determine residential status, that is not clarified here. That will be depending on the domestic tax law. So whether person is resident of UK or not, or resident of India or not, that will be decided as per domestic tax law. In India we have a system: 182 days or more, 60 days or more, 365 days or more. Section 6 clause 1. Okay, so this is this much only. I don't think so question can come on this. Person who's resident of either of the states or both the state. Article 2, taxes covered. This also question less likely, except for one point. On which taxes will this be applicable, that parties will have to clarify. Ideally they cover taxes on income and taxes on wealth. Instead of wealth they call it as capital, taxes on capital. Taxes on capital does not mean capital gains tax. Tax on capital mean wealth tax kind of a tax, property related tax, which was there in India in the name of wealth tax. Now it is no more there since 2014. It's been 11 years. However, whenever countries enter into DTAA, in this article 2 they will have to clarify on which taxes they want to enter into agreement for. Ideally income tax, but apart from income tax other taxes can also be covered. So this convention, para 1 says, this convention shall apply on taxes on income and taxes on capital like wealth tax levied on behalf of contracting state or its political subdivision or local authority. In India, income tax is charged by central government. Countries like USA, taxes are charged by state governments. There are 50 states in USA. Income tax is not charged by central government of USA, it is charged by state government. So their clarification will have to be inserted in this para 1, whether it is charged by government or it is charged by political subdivision of that government or charged by local authority. What will be regarded as taxes on income and taxes on capital, that also will have to be clarified in para 2. Para 3 countries will have to give a list of names of the act, on which of the act or which of the income tax act or capital gains tax act or wealth tax act, they will have to write down the list of names out it here. So it will be divided into two parts: list of taxes covered by this convention in state A so and so, and second list state B. Generally income tax act, but some countries they have a separate act for charging tax on capital gain. Some countries have a separate act for charging tax on salary and wages, and separate act for charging tax on remaining income. In our country, everything is merged together under one act. Okay. Now fourth para is important. Now supposingly tomorrow income tax act is scrapped, agreement is entered into for income tax act. Tomorrow income tax act is replaced by direct tax code. Then will there be any requirement to enter into a fresh agreement with so many countries? Answer no. Para 4 of article 2 clarifies, if existing law is replaced by another law which is similar to it, then no need to enter into fresh agreement. It's just that parties will have to notify each other. India will have to notify all the countries that now onwards, this is the copy of our new act. Now onwards, or from so and so date, income tax act is scrapped, this act will be applicable. This is basically for avoiding a need to enter into a new treaty every time whenever there are changes. Same rule applies in case when there are amendments to the income tax act every year. No need to enter into fresh treaty. Same treaty will continue, but parties will have to notify each other about the changes made in the taxation law. First para says that general scope, this convention applies to persons who are residents of one or both the states, but does not clarify how to calculate residential status or how to determine residential status. Even in article 4 also it is not clarified. Article 4 is titled as resident. Now the question is, what do you mean by person who is resident of one of the states or both the states? Resident means a person who is liable to tax. Person who is liable to tax. Person who is liable to tax in such state by reason of his residence or by reason of his domicile or place of management or place of incorporation. Place of incorporation word is covered only in UN Model Convention or any other similar criteria. Here it does not clarify how to determine residential status in para 1. Residential status, let me warn you, is to be decided as per domestic law only. What does this clarify? It says that if the person is liable to tax in a particular state because of his residency in that state, because of his domiciliary in that state, because of his place of management in that state or place of incorporation in that state, then that person will be called as resident. A person may be liable to be taxed in a given state because of two reasons. Either that person is resident in that state or that person is earning income from that state. Here it's very clear, person who is liable to tax in a given state because he is resident of that state or because he is domiciled in that state and not because he is earning income from that state. Person who is liable to pay tax in a given state because he is earning income, then that shall not be the factor. A person liable to tax does not mean that tax should have actually been paid. Even if person who is primarily liable to tax because he is resident of that state, but he is earning exempt income which is exempted as per domestic law, then that is also considered as person liable to be taxed because of his residency. Residential status, resident does not include person who is liable to tax in that state only because in respect of income from source in that state. Okay, so it should include a person who is liable to pay tax in that country because he is resident. Ultimately, residential status will not be governed by Article 4. Residential status will be decided as per domestic law only. Para 2 and 3 are important about tiebreaker rule, which we are already done in DTHH chapter. Para 2 applies to a situation where the assessee is individual, and being an individual, he turns out to be resident of both the contracting states. If he is resident of both the contracting state, then that will create problem. So solution is that here we will have to finalize out of the two countries in which he is resident, we'll have to finalize and put our rubber stamp on only one of the states based on following 5 factors, but 5 factors are converted into 4 points. One by one we'll be discussing. Number 1, in such situation, if he is individual, he will be deemed to be resident of only that state in which he has a permanent home available. First priority to be given to permanent home. That state in which he has a permanent home available to him. However, if he has a permanent home available in both the countries, both the states, then he will be deemed to be resident of that state with which his personal and economic relationship is closer. Personal and economic relationship is closer, that country is called as country in which associate as a center of vital interest. It's a technical term, which means if I say my center of vital interest is in India, that means my personal and economic relationship is close to India. However, second point, in case if center of vital interest cannot be determined as in his center of vital interest is equally close to both the countries. His personal and economic relationship is close to both the countries. Acha, when are we supposed to look into the center of vital interest? When are we supposed to check that he is with which country his relationship is closer? That is to be checked only when he is resident of both the states plus he has permanent home also in both the states. Then we check personal and economic relationship. However, if he has permanent home in both the states but economic and personal relationship cannot be determined as to with which country is close, then we move on to the second criteria. Then he will be deemed to be resident of that state in which he has habitual abode available to him. Two situations: in case his center of vital interest cannot be determined, or in a situation where he does not have permanent home in either of the states, then he will be deemed to be resident of that state in which he has a habitual abode. Abode means residency and habitual means regularly, wherever he regularly resides. However, next point, in case he has habitual abode in both the states or none of the states, then he will be deemed to be resident of that state of which he is a national. Citizenship, ideally we don't check for the purpose of DTAA chapter, but this is the only place where we will have to check the nationality, that is citizenship. Which state is he resident? In order to determine which state he is resident of out of the two states, we will have to find which country he is national of. In case he is national of both the states or none of the states, then he will be deemed to be resident of that state which is determined as per mutual agreement procedure. As a last resort, tax authorities or the tax representatives of both the states will sit together and decide and finalize any one of the country. Permanent home includes a home taken on rent on a long-term basis, but does not include a home taken for a shorter period. This is slightly an important point. I have my house at USA, but I don't go there. It is my ownership house. When we say availability of permanent home does not mean your own house. Permanent home means a place where associate actually resides or is meant for his own residence. In case if I have a house in USA which I have let out to somebody, though it is ownership flat, I have given it on rent, then it is not my permanent home. At the same time, I have taken another home in UK which is on rent, but I stay there, though it is on rent, does not belong to me, it will be considered as my permanent home. So permanent home will include home taken on rent also. However, it should have been taken for a longer period, not for a shorter duration like 1 or 2 days, 1 week, 10 days. That will be like a hotel accommodation. Para 3 talks about tiebreaker rule for other than individuals, non-individual, company, partnership, firm, LLP. How can they be resident of both the states or two states? This is possible only in case where out of the two states, in one of the state, company is registered, incorporated, but it has place of effective management in the other state. And the first mentioned state considers residential status based on place of incorporation, and the second mentioned state considers residential status based on place of effective management. Management is in second country, incorporation is in the first country. Both the countries consider the same associate as resident of their own country. Then in such situation, compulsorily only one option, no 4 options, map. Residential status will be decided according to mutual agreement procedure between the tax representatives, that is competent authority of both the countries, having regard to place of effective management and place of incorporation or such other factors. Article 4 is over. Remember, Article 4 does not clarify as to how to determine residential status. Article 4 is more important as compared to any other articles because of theory points. There are certain points. Questions have already come, especially on para 1, dual residency, then what to do. Article 5, permanent home, very important. Article 5 describes the term permanent establishment with various inclusions and various explanations. Permanent establishment, we know pretty well, is nothing but the fixed place of business. We had this terminology in this chapter called transfer pricing also. It was defined in section 92F clause 3A. However, Here also same definition is there. Permanent establishment ideally means branch, shop, showroom, godown, factory, etc. A subsidiary company cannot be a permanent establishment because subsidiary company is a separate entity having separate tax identification number. The correct interpretation of permanent establishment is very much relevant for taxing incomes under so and so articles, mainly business income. Given income which I have underlined will be taxable either in state of source or state of residence, but if the assessee has earned these incomes, PGBP, interest, dividend, royalty, etc., has earned this income through a permanent establishment, through a branch, then, and the branch is located in the third country, then in such situation, income given will be taxable in that country where permanent establishment is available, irrespective of state of source, state of residence. Okay. Permanent establishment is defined in section 92F clause 3A, but in an inclusive manner in transfer pricing chapter. It says PE includes a fixed place of business through which business of the enterprise is wholly or partly carried on. Same definition is there here also in para 1, says PE means. What is the difference? In Income Tax Act it says PE includes and here it says PE means. That's one of the difference. PE means a fixed place of business through which business of the enterprise is wholly or partly carried on. However, para 2 provides examples. It says PE includes place of management, branch, office, factory, workshop, mine, quarry, oil well, gas well, any other place of extraction of natural resources, but subsidiary company cannot be a PE of a holding company. PE necessarily means branch, 99%, branch, factory, shop, showroom, godown, etc. Para 3 of OECD Model Convention and para 3 of UN Model Convention. This is about service PE. Slightly different, small differences there. Service PE means, here it says PE means a fixed place of business. So now whether business will include profession or not, whether business will include only trading and manufacturing or it will include service providing business also. So answer, it will include service providing business also. That's why there is a clarification that in OECD Model Convention, following 3 items will also be constituting permanent establishment. Following 3 items will also be, or following 3 types of services will also be considered as permanent establishment. Number 1, construction site. Number 2, building site. Number 3, installation project, provided they last for more than 12 months. These 3 items are reproduced in OECD model also and in UN model also. But UN model has some extra points. UN model has the same 3 points: building site, construction, installation project. Plus it has 2 more items: assembly and supervisory activities in connection with that. Assembly line as well as supervisory activity in connection therewith, provided such services or activities they last for more than 6 months. OECD model lasts for more than 12 months. UN model, it should last for more than 6 months, and India generally follows UN model. Then UN model has one more point. So UN model has how many extra points? 1, 2 plus this point, totally extra. Furnishing of services. Furnishing means providing of services. Providing of services including consultancy services through personals or employees, provided such service lasts for more than 183 days, greater than 183 days in the same or connected project in any given 12 months period, in any continuous 12 months period. There is a clarification inserted by me based on some case law that project office and liaison offices do not constitute PE generally. However, advertising activity will certainly not be a PE. None of them. So project office, liaison office and advertising activity, they are not considered as PE. Okay. Now para 5 of same article 5, it includes agency PE. This is important. Agency PE, also called as Dependent Agent Permanent Establishment, DAPE. Dependent Agent Permanent Establishment. Here 3 types of people will be called or will be considered as dependent agent, and because of that the given person will constitute permanent establishment of the non-resident. It says person who habitually concludes contracts. Person who habitually concludes contracts or habitually plays principal role leading to conclusion of contract. Same thing was there in section 911 explanation 2 clause A, explanation 2 clause A, which has the same meaning. However, explanation 2 clause A contains the old meaning also and the new meaning also, which I will explain you in some other chapter, BEPS, base erosion and profit shifting. Habitually plays principal role leading to conclusion of contract. What do you mean by exercising the authority to conclude contract? Concluding contract means saying yes or no on behalf of non-resident. Supposedly, I am being appointed as an agent for Samsung. Samsung recently launched S25 series phone. S25 series phone cost around 1,25,000. But some few females approach me. I am appointed as an agent of Samsung. Some people approach me that, sir, we want it in pink color, but Samsung S25 is available in, let's say, black and silver color. These people want it in pink color. They are ready to pay extra. They want 1,000 pieces. So they approach me. If I have the authority to say yes, if I can say yes, okay, I'll charge you 1,50,000, but we will manufacture it in pink color also. Then that is called exercising the authority to conclude contract. I am concluding contract. I am saying yes or no. I am finalizing the contract. So person who habitually concludes contract, regularly concludes contract on behalf of non-resident, or a person habitually plays a principal role leading to conclusion of contract, then that person will be deemed to be dependent agent. And the contract should be in the name of enterprise, non-resident enterprise. Contract should not be in the name of agent himself. Contract should be in the name of. So if I am an agent for Samsung and some females approach me asking me whether 1,000 handsets can be manufactured or not in pink color, if they are ready to pay extra, if I have the authority to say yes, if I say yes, that means I have concluded the contract. Or if I say no, sorry, I can't decide, let me ask head office, let me ask Samsung, or take this number directly ask, then that means I am not concluding the contract. I would be deemed to have concluded contract only when I can say yes or no. Then that dependent agent will constitute PE for that enterprise. However, there is one para 4 and para 4.1 which is not covered by our institute. Para 4 talks about some exceptions. Activities mentioned in para 4 exclusions. Activities of the dependent agent are limited to activities mentioned in para 4 other than circumstances mentioned in para 4.1, then he will not be constituting PE. What is para 4? Para 4 says if the activities of fixed place in India, activities of that fixed place in India is constituting either auxiliary services or auxiliary or supplementary, that is preparatory service, preparatory services by nature, then that particular enterprise, Samsung, will not be deemed to be having permanent establishment in India. Permanent establishment will be there only if permanent establishment is carrying on some hardcore activity which is beyond auxiliary or beyond preparatory. Auxiliary means support service, incidental service like billing service, back office works, billing service, accounting work, etc. These are low level services, they are auxiliary services. So in that case, if Samsung, the South Korean company, has a fixed base in India, fixed place in India which provides them these services, then according to para 4 of DTAA or Model Tax Convention, that fixed place will not constitute business connection in India or will not constitute PE in India. However, para 4.1 which I will explain you, which is anti-fragmentation rules, which I will explain you in some other chapter, BEPS chapter, base erosion and profit shifting. Note, according to UN model, two extra people will be deemed to be dependent agent. Person who, if such person maintains stock of goods or merchandise, number 1, he maintains stock of goods or merchandise, or he provides storage services. Simply here he means storage of stock or merchandise. And as per section 911 explanation 2 clause A, if one more person is included, person who not only maintains goods, person who secures orders on behalf of non-resident will also constitute business connection. Insurance PE, which is unimportant, says insurance enterprise of a foreign state or one contracting state. Enterprise means person and insurance enterprise means ideally insurance company. Insurance company of one contracting state either collects the premium from persons resident in India or insures the risk other than reinsurance risk in India through a dependent agent, except in case of reinsurance business through a dependent agent, then it will be deemed to be having a PE in the other contracting state. Are you clear? Okay, now the next is Article 7, business profit. This is important. Business profit is very straightforward. According to para 1 of OECD model as well as UN model, business profits will be taxable only in state of residence, SOR only. So, in case if there is this company called Samsung, let's try to understand with the help of an example. South Korea, in South Korea there is this company called Samsung. South Korea will be state of residence. Samsung exports mobile phones to India. India will be state of source. It exports mobile phones to India worth 100 crore rupees. Receives 100 crore in South Korea. Out of 100 crore, 60 crore is the cost of mobile phones, 40 crore is the profit. Which country will this profit be taxable? Answer: profit will be taxable in SOR only. Profit will be taxable in South Korea. However, unless the profit is earned through a permanent establishment, if it is earned through a permanent establishment in the other state, branch in the other state, then that much profit, as much as is attributable to branch, as much as is attributable to a PE, will be taxable in that country where PE is located. So only two possibility, either taxable in SOR, or in case if the business is done through permanent establishment, branch in the other country, then that much profit will be taxable in that state where PE is located, as much as is attributable to branch. Let's try to understand this also with the help of an example. Supposingly, same Samsung from South Korea, which is state of residence, Samsung exports mobile phones to India, but this time Samsung is doing business in India through a branch. Samsung sets up a branch in India instead of exporting directly, and it exports mobile phones through branch and receives 100 crore, everything remaining same. 40 crore is a profit. This time 40 crore will be taxable in India, the country where PE is located. And supposedly PE is not located in India. If it is located in some third country, neither in India nor in Korea, it is located in third country. For example, Samsung from South Korea, which is state of residence, sets up a branch in Bangladesh. Permanent establishment is set up in Bangladesh. Then it exports mobile phones to Bangladesh branch, and then Bangladesh branch exports the mobiles to India, and the same amount of figures, same profit figure of 40 crore is earned. Then now this time 40 crore will be taxable in Bangladesh, wherever permanent establishment is located. Right, this is slightly important. The rules for Article 7 business income are slightly different as compared to other heads or other articles. Force of attraction rule, this is slightly an important point. Force of attraction rule, this concept is there only in UN model, which India generally follows. Which model India follows? Don't forget, India generally follows UN model tax convention. And this force of attraction rule concept is only in UN model convention. What does it say? Let's try to understand with the help of an example. This extra point is there only in UN model. Force of attraction rule, for example, in India, there is this company called Tata Motors. Tata Motors, India will be state of residence. Tata Motors sets up a branch in UK, it sets up a showroom in UK, showroom constitutes PE, and then it exports 10,000 cars to UK, earns profit. Where should this profit be taxable? Since there is a branch or permanent establishment in UK, and this profit from 10,000 cars is earned because of PE, therefore this profit should be taxable in UK. Otherwise it would have been taxable in India. Now supposingly, in the same example, some cars, 10,000 cars are exported through showroom in or PE in UK, and some cars are exported directly. Tata Motor also exports 4,000 cars directly without involvement of PE. Where should this profit be taxed? This profit ideally should be taxed in India. It should be taxed in the state of residence, that is India. However, under force of attraction rule or as per force of attraction rule, FOA rule, the profit on this 4,000 cars will also be taxable in UK, wherever PE is located. Provided this is export of same product, whatever is a product sold through showroom, through PE. If some other product is sold, instead of 4,000 cars, had it been 4,000 mobile handsets, then it's a different product. 10,000 are cars sold through showroom, and 4,000 if it is mobile phone, then profit from 4,000 mobile phone would be taxable in India. This is called force of attraction rule. In other words, once an enterprise of a particular state, that is Tata Motors of India, sets up a branch or PE in the other state, then all profits will be taxable in that state, whatever profits are earned from that state, everything will be taxable in that state. Whether it is earned through PE or it is earned without involvement of PE, whatever is the profit earned from UK, everything will be taxable in UK as per force of attraction rule. This is important. Once an enterprise of a PE has a PE in the other state, then apart from the income attributable to PE, other income earned through direct sale of same goods or same business activity earned from the same state but without involvement of PE will also be taxable in that state where PE is located. Simple language, as per force of attraction rule, once an enterprise sets up a PE in the other state, then what will be taxable in that state of PE is not only the profit attributable to PE but also profit from or income from export of other goods or services which are of same nature, which are same as whatever is exported or whatever is sold through PE, will also be taxable in the same state instead of getting taxable in the state of residence. So if there is a combination of both, then under force of attraction rule, as per UN model, everything will be taxable in UK. Had it not been UN model convention, had these countries been following OECD model convention, then profit from sale of 4,000 motor cars would have been taxable in India and 10,000 motor car profit would have been taxable in UK. Next is Article 11, interest. So next should have been Article 8, 9, 10, but which everything is not covered by our institute. We will be focusing only on those whatever is covered. Interest. So there are 4 paragraphs one by one. Interest, just like business profit, here also first priority will be given to state of residence. Interest, para 1 will be taxable in SOR in both the model convention. However, in both the model convention, para 2 says that SOS can also charge tax. Tax may be also taxed, income may be taxed, interest income in SOS also. But if SOS, state of source, charges tax or wants to charge tax, will have to charge tax on a gross income, gross interest, but at a concessional rate. At a concessional rate on the gross basis. However, as per how much concessional rate? So as per OECD model, the concessional tax rate should not be more than 10%, shall not exceed 10%. However, as per UN model, which India generally follows, the maximum rate in SOS has to be determined as per bilateral negotiation. That is the difference. Para 3 talks about the meaning of interest. Interest means any of the followings. Number 1, income from debt claims of every kind. Income from debt claims of every kind, whether it is secured by mortgage or not, or whether it is carrying any right to participate in the profits of debtors or not. Second, income from government security and income from bonds and debentures. Bonds, debentures, government security, including premiums and prices on it. However, important point is last, penalty shall not be considered, penalty for late payment shall not be considered at par with interest, and accordingly penalty will not be taxed as per Article 11. Para 4, last paragraph, in case if the interest is earned through permanent establishment in the other state, if ideally income by way of interest should be taxable in the state of residence. As per para 2, it can be taxed in SOS also. But as per para 4, in case if the income by way of interest is earned through a permanent establishment in some other country, then entire interest attributable to PE connected with the PE will be taxable in that state where PE is located. Neither in the state of residence nor in the state of source will be taxable in the state of permanent establishment. So it is described in terms of 4 conditions in para 4. Interest earned through PE. If the beneficial owner of interest is resident of one state but carries on business through PE in the other state. Person is resident of one state, person who is going to earn interest, taxpayer, but he is resident of other state. And interest arises through PE, and interest is on what? Interest is on money borrowed or debt claim. The debt claim in respect of which interest is paid is effectively connected with such PE. Then interest will be taxable in that state where PE is located. With that, Article 11 comes to an end. Article 12, royalties. Royalty is nothing but rent for an intangible asset. But just like interest, here also there will be 4 paragraphs. First paragraph will say state of residence will charge tax. Second paragraph will say state of source can also charge tax at a concessional rate. Third paragraph will define the meaning of or explain the meaning of royalty. And fourth paragraph will say if royalty is earned through PE, then it will be taxable in that state where PE is located, neither in the state of residence nor in the state of source. Royalty, However, in some treaties, apart from royalty, FTS is also covered. Some treaties include FTS also in Article 12 only, along with royalty. This happens only for OECD model. As far as UN model is concerned, in UN model, royalty is separately covered and FTS is separately covered. In UN model convention and OECD model convention, OECD MTC, royalty is covered by Article 12, both the places. But as far as FTS is concerned, OECD model convention does not have any specific article for FTS. UN model convention Article 12A is applicable, which we will be discussing after this. So what to do with FTS for those who are following OECD model convention? They have this option, first option, three options. They can include, FTS can be included or can be covered up in Article 12 itself. Second option, they can treat it as business income, consider it as business income and cover it in Article 7, which we just finished. Or alternatively, they can cover it up as other income, Article 21, which we have yet to discuss. Three options. So some people who follow OECD model convention, they cover FTS in this article itself, Article 12 itself only, and some of them cover it in, make it fall under Article 7 as business profit, or make it fall under Article 21, and then rules and regulations of Article 7 or 21 will apply. In UN model convention, this problem does not arise because FTS is separately covered in the next article, Article 12A. So royalty, para 1, which country will charge tax? So as per OECD model, it will be taxable only in state of residence, only shall be taxable in SOR only. But as per UN model convention, it can be taxed in SOR also. Primary right of taxation is given to SOR. It can be taxed in SOS also. So para 2, which is only in UN model convention, says that FTS, royalty, will be taxable in a state of residence primarily as per UN model convention. But SOS can also charge tax. It may be taxed in SOS also, but at a concessional rate on the gross amount of royalty. So as per OECD model, can be taxed only in SOR. As per UN model, can be taxed in SOR as well as SOS. Second para, which is there only in UN model, says SOS can also charge tax, but at concessional rate. How much concessional rate? Maximum rate to be determined as per bilateral negotiations. However, para 2 of OECD model convention and para 3 of UN model convention talks about the meaning of the term royalty. This meaning is little complicated, and our institute had kept one question in the module at the end of this chapter, not asked in the exam but in module. What do you mean by royalty? Royalty means consideration. Even in Article 11, interest, this third paragraph was on meaning. Consideration for use of any copyright, patent, trademark, design, model, plan, secret formula, process, information. However, in UN model, this is the common meaning in both the model conventions, UN model also, OECD model also. However, in UN model convention, there are two extra payments which are also classified as royalty. Which two payments? Number one, consideration for right to use films or tapes which are used for radio or television broadcasting. Right to use films or tapes which are used for radio or telecasting, or consideration for the use of or right to use any industrial or commercial scientific equipment. Ideally, royalty is understood as rent of an intangible asset. This is the first time in clause B, if you see scientific equipment or commercial equipment or industrial equipment, the consideration for equipment is ideally considered as a lease rental. It is considered as a rent, not as royalty, but UN model has covered it under this category, under the category of royalty. So it will be offered under royalty, and India follows UN model convention, and this is there in UN model convention only. In OECD model convention, these 2 points are not there. What to do? Answer, these 2 points in OECD model convention, again same thing, can be put under Article 7 as business profit, or can be put under Article 21 other source income. The next is para 3 and para 4. Para 3 of OECD model and para 4 of UN model. It says royalty connected with the PE. Again 4 condition. Royalty connected with the PE means royalty earned because of permanent establishment in some third country. then the royalty will neither be taxed in the state of residence nor will it be taxed in the state of source. It will be taxed in that country where permanent establishment is located. Same as para 4 of article 11 on interest. 4 condition: if the beneficial owner of royalty is resident of one of the contracting states but carries on business through PE in the other contracting state and royalty arises through that PE, that means royalty is earned because of that PE, and right to earn income or right to use or the property in respect of which royalty is paid is effectively connected with the PE, then such royalty will be taxable in that state where PE is located. Simply, Article 7 business profit, Article 11 interest and Article 12 royalty, everywhere same concept. If the income is earned, given income is earned through a PE in the other state, then that much income which is attributable to PE will be taxable in that state where PE is located, except in case of force of attraction rule, which is applicable only for business profit and only in UN model, where it says once the PE is constituted, then all business profits will be taxable in that state, whatever is earned from that state, whether through PE or without PE. Article 12A, which is there only in UN model convention. Article 12A was introduced somewhere in 2017, the latest draft of UN model convention. Fees for technical service, FTS. Ideologically, since it is UN model, the first right will be given to SOR, but SOS can also charge tax, but SOS will have to charge tax at a concessional rate. Para 1, it will be taxed in SOR, may be taxed. Para 2, it may be taxed in SOS also, but at a concessional rate on gross amount of FTS. Wherever it is concessional rate, it is always on the gross amount, without Chapter 6A deduction, without basic exemption, without any expenditure. That's an important point. Rate to be determined through bilateral negotiation. Para 3 as usual will define FTS. FTS means MTC services, managerial, technical or consultancy services, but does not include. So one line definition, so important, slightly important from exam perspective. Managerial, technical or consultancy services are called as fees for technical service. This is incomplete definition, but it's good that only one line definition. We just have to remember it from exam purpose, but does not include following 4 items. Same payment received by an employee, payment to an employee. So in case you are an employee of somebody and you are providing your employment services, though it is fees for technical service, it will be classified as salary. It will be governed by a separate article, Article 15, which is not covered by our institute. Payment for teaching in an education institution or by an education institution. What do you mean by in an education institution and what do you mean by an education institution? So when we say payment for teaching by an education institution, that means payment by coaching class or the education institution to the teachers, and payment for teaching in an education institution would mean student making payment to education institution. However, UN people should have clarified it. They are also like our income tax department and our finance ministry department. They are also full of mistakes or incomplete provision. And para 4 as usual, if the same FTS is connected through a PE, effectively connected with the PE, meaning thereby 4 conditions, then where will it be taxable? Then it will be taxable in that state where PE is located, PE or the fixed base is located. So slightly different language is used. Here in UN model, apart from PE, they use the word fixed base. It says if the beneficial owner of the FTS is resident of one contracting state but carries on business through a PE or the fixed base in the other state, instead of PE, alternatively as a substitute word, they use the word fixed base. The FTS arises through that PE or the fixed base and the FTS is effectively connected with such PE or fixed base, then FTS will be taxable in that state where PE or the fixed base is located. Okay, very simple. Everywhere 4 paragraph. Ideologically, concept in Article 7 is slightly different. In Article 7, only state of residence will charge tax unless through a PE and unless force of attraction rules apply. Article 11, Article 12 and Article 12A, all the 3 incomes, state of residence will charge tax primarily, but state of source can also charge tax at a concessional rate. And 3rd paragraph will talk about the meaning and 4th paragraph will talk about given income earned through a PE in the other state. Article 13, capital gain. Capital gain, here they don't use the word transfer of capital asset, they use the word alienation, which we discussed at the beginning of the chapter. If the property is alienated, capital asset is alienated, then where will it be taxed? Which country will it be taxed? So we have divided assets into 6 categories. Summary or provisions of Article 13. Capital gain arising from alienation of which asset? What is the asset? As per OECD model, what is the provision? As per UN model, what is the provision? For first 3 provisions are same. First one, important and very simple also. Gain arising from alienation or transfer of immovable property. Land, building, land plus building. Obviously, everyone would agree unanimously that it should be taxed in that country where immovable property is located. Wherever immovable property is located. Second also, concept is same in OECD model and UN model. Movable property which is connected with the PE. Movable property which is connected with the PE. What if it is not connected with the PE? Then it will come later. It will come. We are dividing assets into 6 categories, so have patience. If it is movable property transferred which is connected with the PE, we don't say connected with the PE, we actually understand it as owned by PE. Asset which is movable property which is belonging to the PE. But we can't use the language belonging to the PE or owned by PE. Reason is PE is a branch and head office are considered to be one and the same. For example, JK Shah classes Andheri branch, Andheri head office, and let's say Charni Road branch. So Charni Road branch does not have a separate identity. So when we say Charni Road branch is owning it, they are the owner, then technically JK Shah classes is the owner, right? Because branch does not have a separate identity of its own. Therefore, we don't say owned by PE, we say it is effectively connected with the PE. Then it will be taxed in that country wherever PE is located. Same concept in OECD model, same concept in UN model. Ships, aircraft, boats which are generally operated in international traffics, international waters or international sky or international traffic. Then here we cannot tax it in the country where the asset is located or asset is transferred. Here by default it will be taxable in the country where alienator is resident of, where alienator, that is transferor, is resident of. Same provision in UN model, same provision in OECD model. India follows UN model, remember. D and E point for shares, only for shares, not for other securities. Keep it in your mind, whether equity or preference, ideally equity share, but only shares. Shares, such shares which derive more than 50% of its value from immovable property located in a third country. Deriving more than 50% of their value from immovable property located in other country. Then provisions are same in OECD, provisions are same in UN model. It will be taxed in that country where immovable property is located, where immovable property is situated, and not in the country where transferor is resident, and not even the country where the company whose shares are transferred is resident of. So if it is shares of Indian company, then we know pretty well Indian company shares are transferred, then capital gain should accrue arise in India. India should have a right to charge tax. But if the same shares are deriving more than 50% of their value from property located in China, then gain arising will be deemed to be accruing arising in China, will be taxable in China. But if the other shares other than those shares referred to in clause D, remember we are talking only about shares, not about other security. Shares are transferred, what will happen? OECD is silent about it, about such other shares, normal shares is silent, then next point will be applicable, have patience. But OECD, there is a OECD there is no clarification, so next point will apply. But in UN model, this asset is separately covered. Where would it be taxed? It will be taxed in the country where company whose shares are alienated is resident of. Company whose shares are transferred is resident of. Indian company shares, then gain will be deemed to be accruing in India, taxable in India. Pakistani company shares, then gain will be taxable in Pakistan, and so on. Last is any other property, So this particular point which was not covered in OECD model, this asset will fall under other property category. In other property, provisions are same in UN and OECD model. Other assets will be taxed in that country where alienator is resident, where alienator, that is transferor, is resident. So as per OECD model and as per UN model, if we were to talk about shares of Indian company which are not falling under category D, not deriving more than 50% value from immovable property located in third country, normal shares, shares of let's say Reliance Industry, as per OECD model it will fall under this category. It will be taxed in that country where alienator is resident, and as per as per UN model which India follows, it will be taxed in that country where the company whose shares are transferred, company whose shares are alienated is resident of. Indian company shares, then as per UN model, gain will be taxable in India. But as per OECD model, gain will be taxable in that country where transferor is resident. Article 14, income from independent personal service. Independent personal service, this concept is there only in UN model. It was there in OECD model also, but it was deleted on 29th April 2000. 25 years back it was deleted. Doesn't matter, as of now it is there only in UN model. So what will happen when this kind of income is earned by a person resident of a country which follows OECD model? Under OECD model, this article is deleted. So what will happen? Then as usual, just like other articles, just like FTS, here also for such income under OECD model will either fall under Article 7 or will fall under Article 21, business profit or other income. Article 14 deals with income from professional services. What do you mean by independent personal service? Independent personal service is defined here, which means two types of income. Number one, professional income, doctor, lawyer, engineer, chartered accountant, even teachers are also covered here. And income of freelancers. Freelancers means income of independent activities of independent character. Article 14. In case you are working as an employee, then Article 15 will apply, which is not covered by our institute. Article 15 is titled as income from activities of dependent personal service. Dependent personal service means you are dependent on your employer. You are receiving income from your employer. That is Article 15, which is not covered. Article 14, independent personal services, which means freelancers basically, including all professionals. However, there is a clarification that freelancers here would not include sportsmen or athletes, will not include entertainers. Recently, Coldplay band had come to India to perform. Those people will not be covered here. For them, there is a separate article, Article 17. Those pop singers or these people, entertainers we call them as, or film artists, entertainers will be covered by Article 17. They will not fall under this article even if they are freelancers, stand-up comedians, singers, etc. Para 1 and Para 2, only 2 paragraphs are there. Understand very clearly. Here we are mainly talking about income of professional people and of freelancers. Where will it be taxed? The answer primarily, see, this is covered only in UN model. OECD model does not apply only. And UN model, if you recollect at the beginning of the chapter we discussed, both the model conventions, one of the primary difference is that as per OECD model, everything gets taxed in SOR. But as per UN model, which India follows, rights of taxation is given to both the countries. SOR also, SOS also, but primary right will be assigned to SOR. Which country? The answer will be taxable in SOR only, except in following two situations. Here there are only two paragraphs, 1 and 2. Primarily it says taxable in SOR except in following two cases. Number one, in case where the person, let's say you are a doctor, and being a doctor in India, you got some surgery assignment in UK. So in such situation you went to UK and you earned 10 lakh rupees from UK. From that operation, surgery in UK, you earned 10 lakh rupees. Which country should it be taxed? Answer, primarily SOR, and India is the SOR for you, so that 10 lakh should be taxable in India. However, in case you are having a fixed base in that country, UK, you are having a fixed base as in you are having some hospital, nursing home, which is yours or which you have taken on rent, which is available for you exclusively. That is called fixed base. In case if the assessee person has a fixed base regularly available to him, not necessarily all 365 days, regularly available to him for in the other contracting state, then that much income which is attributable to fixed base, that much income which you earn from UK through that nursing home, dispensary, clinic, hospital will be taxable in that state where the assessee has a fixed base available to him. Or alternatively, whether fixed base is there or not, in case you stayed in UK, your stay in UK was 183 days, more than 183 days, greater than or equal to 183 days, in any 12 months, so don't think that by staying in UK for 183 days you would have become resident of UK. Then a question of taxing it in India does not arise only. Income is accruing also in UK and you are resident also of UK. Both the things are in UK. How can it be taxed in India? No. 183 days not in one financial year. It says your stay in UK, either you have a fixed base regularly available as per clause A, or your stay in that country UK was 183 days or more in any 12 months period, ending in the current year, current financial year, or beginning in the current financial year, then that much income which is earned from UK, income derived from that state, will be taxable in that state, even if you don't have a fixed base. What do you mean by professional service? That is clarified in the second point. Professional service includes professional services covered here. So Article 7 will not apply. Article 7 is only for business profit. Professional incomes will be falling under this. But it should be professional income as an individual, independent service. In case you are having a partnership firm of chartered accountants, you are 3 partners running CA firm, and then you are earning income, same professional service, then it will not be classified as professional service, it will be classified as business profit. Article 7 will apply. Professional service will include services of independent scientific service, literary, artistic, educational, teaching activities, independent activities of physicians, lawyers, engineers, dentists, accountants. This definition is only for your understanding. You don't have to memorize it. Some points to be noted saying Article 14 will not apply to professional services rendered as an employee, because in such situation it will be covered by Article 15, dependent personal service, and will also not include income of entertainers, that Coldplay band, artists, sportsmen, athletes. Such incomes are specifically covered by Article 17, so that will not fall here. Article 14 does not even apply to FTS, because for FTS we have a specific provision, Article 12A. And last, OECD Model Convention, other incomes were there earlier. Article 14 was deleted on 29th April 2000. What to do? Then will be taxable either as business profit, Article 7, or can be taxed as other income, Article 21. So what is Article 21? Article 21 has got 3 paragraphs which are not specifically covered in any income which is not specifically covered by any other article of this particular model tax convention. Like for example, winning income, donation income, which we don't have specific article. Then it will be taxable in SOR only. Here will be taxable in SOR, but as per UN model it can be taxed in SOS also. The UN model, everywhere all incomes SOR, SOS, SOR, SOS, SOS at concessional rate. But this is the place where SOS will not charge concessional tax rate. Here SOR will have a primary right to charge tax, SOS can also charge tax, but SOS will not offer concessional tax rate, will be taxable in SOS at a normal rate. Imagine you earning winning income 1 crore rupees from UK. It is taxed in UK also. When you bring it back to India, it will be taxed in India also. Of course, then benefit of DTAA between 2 countries will be available to you, but primarily it will become taxable in both the countries. Other incomes connected with the PE, that is para 2, connected with the PE, then it will be taxed in that state only where PE is located. If the recipient instead of 4 conditions every time connected with the PE, this time we have 3 conditions. If the recipient of PE, recipient of the other income, is resident of one contracting state, carries on business through PE or fixed base in the other contracting state, and the right or property in respect of which other income is paid is effectively connected with the PE or the fixed base, then such other income shall be taxable in that state where PE or the fixed base is located. And as per UN model, it can be taxed in SOS also, but without concessional rate. That is given in para 3, only in UN model, not in OECD model. As per OECD model, it will be taxed only in state of residence, this income. As per UN model, which India follows generally, it will be taxed primarily in SOR, but SOS can also tax. Such other income may also be taxed in SOS, but at normal rate and not at a concessional rate. Clear? Okay. Then we have Article 23. Article 23, methods of eliminating double taxation. 2 methods, tax credit method and tax exemption method. We know about it. There are 2 methods, tax exemption, tax credit, TEM, TCM. Tax exemption method is known as full exemption method. Remember this. Question can be asked to you, MCQ, based on this. So tax exemption method will be governed by Article 23A and Article 23B will be for tax credit method. India generally follows tax credit method because in tax credit method both the countries will receive some collection, some amount of tax will be received by both the country. In tax exemption method, any one country has to full compromise, any one country has to make a full compromise. Only one country will charge tax, other country will exempt. Therefore, most countries do not follow exemption method. Everyone wants some collection. It has a psychological impact that why should other person take all the benefits? I should also get something. Even though it's a negligible amount, then also. India, like most other countries, prefers TCM. These two methods are applicable only in case there is a juridical double taxation. If there is economic double taxation, then these methods will not apply. In case of economic double taxation, no relief will be given to such persons. We know pretty well. These two methods are not mutually exclusive. This is also an important point. Meaning thereby, both the methods can coexist in the same DTAA, but for different incomes. Like for one income, India will follow TCM and for another income will follow TEM. Possible, allowed. Some incomes may be tax exemption method will be applied, and for other incomes tax credit method can be followed. Starting with Article 23A, tax exemption method TEM. Here, which country will exempt? We know one country will exempt, one country will charge tax, but which country will exempt? The answer, SOR will have to exempt if taxable in both the states. If taxable in both the states, and this method is agreed upon in the DTAA. Now, which method to be followed, that will have to be pre-decided. India generally does not follow tax exemption method. So, when you download any DTAA from income tax portal between India and other country, you will never find this tax exemption method, and there won't be any mention also. There will be straight away tax credit method, which says that tax paid in the other country will be allowed as a credit in the other country. SOR will have to exempt it and SOS will tax. However, this applies only when income is going to be taxed in both the states. If income is pre-decided that it will be taxed only in one state, as if Article 7, business profit will be taxable only in SOR. If only SOR, then these methods are out of question. Will be taxed only in SOR, will not be taxed in SOS, matter over. Okay. Article 23B, tax credit method TCM, which India generally follows. Here, who will give the credit? Answer, here also, every time the compromise has to be made by SOR only, which is given primary right of tax. SOR will give credit of what? SOR, state of residence, will give credit of the taxes paid on such income in the state of source from the tax payable on such income in the SOR, but restricted to the amount of tax on such income in the SOR. Meaning thereby, if the tax paid in state of source is more than the tax payable on the same income in the state of residence, say state of residence 30 lakhs is payable, but state of source has deducted 37 lakhs, then entire 37 cannot be allowed to be claimed as credit against 30 lakhs. Credit will be restricted to, or deduction will be restricted to 30 lakhs, the tax payable in SOR. Excess 7 lakh rupees, balance 7 lakh rupees will lapse. This is popularly called as foreign tax credit FTC, for which we discussed in DTAA chapter. Rule 128 will apply, whereby Form 67 will have to be furnished electronically along with evidences of tax in the other country. Tax paid or deducted in SOS will have to be proved in India, because AO will not have any evidence. No, AO cannot cross verify. That is how proof will have to be given. Taxes paid in SOS will also include tax deducted at source or tax withheld at source or tax payable also, even if not paid. So, one should not follow a literal meaning. Tax paid does not mean tax actually paid. It includes tax payable also, or even in a situation where a tax is not paid by assessee, it is deducted by the payer. If the tax paid in the SOS on such income, the first country, is more than the tax payable on such income in SOR. In SOR, which is going to give credit, tax payable is 30 lakhs. Tax paid in SOS is 37 lakhs. 37 is more than 30. 37 entirely will not be allowed as a credit. Then excess FTC may either lapse or can be carried forward to subsequent year depending upon the treaty. But as per India's treaty entered into by India with other country, FTC will lapse. Excess FTC will lapse. Okay, this can also come in the exam as a question. With that, article 23A and 23B are over. Let me just take you back to my normal classroom slides where I had given example of this excess FTC. So, excess FTC will lapse. I will give you one example from my regular classroom note. Suppose Mr. X is a resident of India. He earns income from he goes to USA try to put yourself in the position. Say you are resident of India, you went to USA, you earn 100 lakh rupees. In USA tax rate is 22%, 22 lakh tax you paid, balance left out with you in the pocket is 78 lakhs. Same illustration we had discussed in DTAA chapter as well. Now you must have repatriated back to India 78 lakhs, the amount left out. However, 22 lakhs tax paid in USA will not be allowed as a deduction in India as per section 40 clause A subclause 2. Tax paid outside India will lapse. So in India, income will be deemed to be 100 lakhs. On 100 lakh tax rate is 30%. From 30%, which is amounting to 30 lakhs, entire 22 can be claimed as a credit, because 22 lakh is less than 30 lakh. So full 22 allowed as a credit. In India, balance 8 lakh will have to be paid as a tax. Reverse order, Mr. Y is resident of USA. He comes to India and earns income 100 lakhs. In India, tax rate is 30%. At 30%, tax works out to be 30 lakh rupees. Then he goes back to USA. He would have been left with 70 lakh rupees. So he could have repatriated back to USA only 70 lakh. But in USA also, just like income tax, taxes paid on income are not allowed as a deduction world over. So USA will also consider income to be 100 lakh and not 70 lakh. In USA, tax rate is 37%. Tax works out to be 37. Now it is the turn of USA to give credit of tax paid in India as per taxation law applicable in that country. 37 is more and 30 is less. Therefore, full 30 will be allowed as a credit FTC and only 7 lakh will be payable in USA. That is how double taxation gets avoided. However, real situation is this. Mr. Z, resident of India, try to put yourself in the position of Mr. Z. You earn income of 100 lakh from USA. Tax charged is 37%, 37 lakh. Then you came back to India. You must have repatriated back only 63 lakhs. But tax paid in US not allowed as a deduction. In India, 100 lakh will be considered as your income. Tax payable is just 30%, 30 lakh rupees. From 30 lakh, the tax paid in US, 37 lakh, is going to be allowed as a credit. But 37 lakh restricted to 30 lakhs, restricted to tax payable on such income in India. Indian government cannot give you credit of full 37. If it allows you credit of 37, there will be refund of 7 lakh rupees. Who will give you refund of 7 lakh rupees? The tax which you have paid with US government. Why would Indian government refund it back to you? For what? Therefore, excess 7 lakhs will lapse. Some countries allow carrying forward of 7 lakhs to the next year, but most countries do not allow. We don't know about other country. India does not allow carry forward of this credit. In India, this excess FTC will lapse. Simple. Okay, coming back here. Then we have a concept of mutual agreement procedure MAP, straight away Article 25. Article 24 is not covered by our institute, but there is a mention of Article 24 in one of the upcoming chapter, which I will explain you briefly when we come to that chapter. Article 24 is titled as non-discrimination clause. Non-discrimination. Not to discriminate between residents of India and the residents of other country. Residents of UK coming to India, they are non-residents in India. Resident of UK will be non-resident in India. India has not to discriminate between resident of UK and resident of India. Both should be offered, or both of them should be charged to tax at the same rate on the same type of income. However, as I said earlier, all these things are not binding. This is not a law. This is model or draft convention which may be followed or in entirety, or maybe after making appropriate changes. So India does not follow all this non-discrimination clause to a large extent. Mutual agreement procedure, MAP, it says whenever there are disputes or disagreements between the two states with regards to interpretation of the treaty or application of the treaty, then how to resolve? Then it can be resolved by mutual agreement between the tax representatives, that is competent authority of the two states. They will sit together on the table and they will discuss it out, they will negotiate, discuss with each other, and they will come to a solution which is acceptable to both the parties on mutual understanding. That is called mutual agreement procedure. This procedure is called mutual agreement procedure, can be done by competent authorities either suo motu on their own, or number 2 on an application made by person who is covered by the treaty, who is subjected to treaty. Okay, when would person subjected to treaty apply for this MAP? Person subjected to treaty will apply for the MAP only when he considers that action taken by any one of the states or both the states, action taken by UK government or Indian government or both the governments, is resulting into or has already resulted into taxation not in accordance with the treaty. If he considers that the action of either of the states or both the states will result or has resulted into a taxation which is not in accordance with the provisions of the treaty. Simply, he has been not subject, he is subject matter of treaty, but the government of either country has not applied the treaty provision and has charged him more tax, then he may feel aggrieved and he can apply for mutual agreement procedure. Where to apply? Para 1. The person who is subjected to treaty considers that the actions of one or both the contracting state has resulted or will result into for him into taxation not in accordance with the provisions of the convention, then irrespective of the remedy available as per domestic law, like in domestic law there is a concept of appeals, revision, rectification, revised return, various concepts are there, but ignoring the domestic remedies, the person may present his case to the competent authority. Which competent authority? He should present it to a competent authority of his state of residence or state of source. So answer, as per OECD model, which India generally does not follow, which is to be followed between developed countries, OECD model, he can present his case before any competent authority, either or both the competent authorities of any state. He can present it before UK competent authority as well as India tax authorities, irrespective of which country is he resident of and which country has done wrong thing with him. However, as per UN model convention, his case has to be presented to the state of resident only, of which he is resident, competent authority of that state of which he is a resident. Is there any time limit to present the case? Answer yes. He has to present his case within 3 years. 3 years from the date on which he got to know about that action of either of the states which will result or has resulted into taxation not in accordance with the treaty. Within 3 years from the first notification of the action resulting into taxation not in accordance with the provisions of the convention. Para 2. The moment this person presents his case to the given competent authority. Right now we will present his case to any one of the competent authority. Then in that case, that competent authority to whom the case has been presented by such person, that competent authority single-handedly on its own will try to resolve the issue, will resolve the issue on its own, and in case the competent authority, let's say it is competent authority of UK, they are unable to resolve, they will try to resolve on their own. They will not contact Indian tax authorities. But in case they are not able to, competent authority of UK is unable to arrive at a satisfactory solution, then it shall resolve the case by mutual agreement. Then they will communicate, then they will contact the competent authority in India that now let's sit together on the table, we are not able to solve this issue, this is the matter, with the competent authority of the other contracting state. And then it is clarified that any agreement reached as per map shall be final, binding, conclusive, shall be implemented in the given country irrespective of the time limit in the domestic law of the given contracting state. Supposing his assessment is to be done in UK, and in UK, just like India, there is a time limit to complete assessment of 12 months, even though that 12 months time limit has already expired long back, then also if once the decision is taken as per mutual agreement procedure, that effect has to be given, that mutual agreement procedure resolution has to be implemented irrespective of the time limit given in respective domestic law. However, in case if the person has presented his case to the competent authority and they tried resolving through mutual agreement procedure, and competent authorities are unable to reach to an agreement within some limited time, which is 2 years in OECD model and 3 years in UN model. If competent authorities of both the countries combined together are not able to resolve in 2 years as per OECD model or not able to resolve in 3 years as per UN model, then the case shall be sent for arbitration. Unresolved issue arising therefrom shall be submitted to arbitration. As per OECD model, case is to be submitted for arbitration only if the concerned person requests that, sir, enough now, you are not able to, now send it for arbitration. And as per UN model convention, which India generally follows, case is to be submitted to arbitration only if either of the competent authorities request. However, what is important from exam point of view is this point: case shall not be submitted for arbitration, case shall not be transferred from mutual agreement procedure to arbitration. See, arbitration is not a different process. Arbitration is a part and parcel of same article. Arbitration is also a part of mutual agreement procedure. Mutual agreement means participation of both the parties. Both the parties are equally involved. It is within their knowledge, within their consent what is happening. So if case is not resolved by these people, then it will be submitted to arbitration. However, case shall not be sent for arbitration if before it is sent for arbitration, the same issue is resolved by any tribunal or any court of either of the countries. Decision on these issues, unresolved issues, have been rendered or already rendered by a court or by administrative tribunal of either of the states, either of UK or of India. Arbitration decision, supposing the matter is sent for arbitration, then whatever is the arbitration decision, in technical language, decision of arbitration panel will be implemented by competent authority for providing resolution of MAP. MAP resolution, mutual agreement procedure resolution, is implementing the arbitration. Arbitration decision shall be binding on both the contracting states and shall be implemented irrespective of the time limits given in the domestic law. Next point is also again very important. Arbitration decision shall not be binding if, as per OECD and UN model both, this is important. When will the arbitration decision be not binding? Will not be binding if the person who is directly affected by the case does not accept the solution, does not accept the mutual agreement procedure, mutual agreement which implements arbitration decision. If you are the one covered and they have UK and Indian authorities have merged together, defined or they have decided something and that decision is not acceptable to you, you have to communicate with them that sorry, this decision is not acceptable to me, and then arbitration decision will not be taken. Or as per UN model, both the competent authorities agree on a different solution within the next 6 months after the decision of arbitration was communicated to them. If they come out with a different solution within 6 months time limit, then the matter will not be sent for arbitration. Next is article 26, which is not that important, exchange of information. Exchange of information means tax related information. Whenever DTAA is entered into, it is not only for the purpose of avoiding double taxation. DTAA will also have a clause where both the countries will agree with each other for regularly exchanging certain tax related information. Which all information can be exchanged, that will be clarified, that so and so information will be exchanged. However, other information can also be exchanged but on demand. So whatever informations are listed out, they have to be exchanged under an automatic route, automatically, without requesting for it, without asking for it. But any other information other than what is covered under automatic route, one country can specifically make a request under request route. Okay, then this article 26 will further clarify that what is the mode of request, what is the mode of sharing information. Information will be shared by email, WhatsApp, Telegram, phone call, fax, telex, or should be sent by post, should be sent on pen drive, soft copy, hard copy, everything would be pre-decided. And what can be done with that information, whether it can be shared with anybody or not, whether it can be shared with the court, High Court, Supreme Court or any tribunal, whether it can be announced to the general public or not, everything would be clarified. What all information can be shared, what all information cannot be shared, that will be given. What is the mode of putting a request, what all informations will not be shared, blacklisted items, everything will be pre-decided. It says the international law do not permit a state to conduct investigation in the other state without its consent. Therefore, this article 26 empowers both the states to exchange information required under the tax treaties and under the tax law. If India needs information from UK government, then Indian officers cannot go to UK and start investigating. Of course, that will not be permissible. Otherwise, UK officers will also come to India and start investigating. That power cannot be given. So, UK government can request us that we need information about our one person who has bank account in your country. Please help us in furnishing information. Please help us in attaching bank account, etc. Information received shall be treated as secret, top secret, can be shared only with the courts or the persons or authorities connected with the assessment or collection of tax or enforcement, prosecution or deciding appeal in relation to taxes. Even such courts or persons can make use of information for the above purpose only. They may disclose the information in public court proceedings or judicial decision. but information cannot be made available to public. So if any particular country like Cyprus has shared a list of Indians having bank account in Cyprus, then India, after receiving the list of 451 Indians having bank account in Cyprus, India cannot make that list publicly available. But unfortunately in India, some idiots don't understand all these rules, regulations. Some of them are politicians also, and that's why people call him as Pappu or whatever. He either is a Pappu or makes people Pappu. In such situation, okay, they know pretty well that government of India cannot share the information except to the court, cannot make it publicly available, cannot publish the names of those people in the newspaper. Then also they keep on putting allegations on government that government is hiding something, government is secreting something. But that is as per international protocols, cannot be violated. That's it. With that, the revision of this chapter is over. Wish you all a very good luck, all the best, and see you in the next video with some other chapter.